Hello YouTube, this is Steven with On My Way to FIRE, channel about early retirement and all things personal finance and investing. And in today's video I want to talk about compounded dividend growth and the magic that happens there. This is an important topic to me because I'd say a majority of my investments, somewhere around 75%, are based on dividends. And I hear a lot of criticism with different fund managers and radio shows talking about dividends because it depends on what type of account you're holding it in. You will be subject to tax if it's in a taxable brokerage account, but there's little things you can do to adjust that, and I made some videos on this topic already. But for this video I want to focus on the frequency and strategies with dividends. So I really like REITs and real estate investment trust companies. There's a structure to them to where they pay out a higher dividend for the most part compared to other companies because of the way they're structured. They generally have to return about 90% of their income, or their profit I should say, in the form of a dividend. So there's a few companies that do it quarterly, but I have some that pay monthly. And what's cool about that is they deposit on a regular schedule, and for the most part the dividend is fixed. You'll get the same amount every month, or maybe a slight increase every so often. But because of the frequency of the dividend every month, you're compounding faster because that money I have set to reinvest in the stock. So it's going to buy a fractional share because I don't have quite enough money in those accounts to justify or to come up with the share price of what it's currently trading at. Some months I might actually get a full share, but it all depends. So I'm going to use an example just for illustrative purposes here. It's not an endorsement for you to buy the stock. You could do your own research and see if it's something that you like. But one of the companies I've held since 2018, and it's going on just about 8.25 years, is Realty Income. And so I put $3,000 into that and purchased 59 shares way back then. And the first month of dividend payments, I got $13.39. And so every month after that, it went up, to $13.42, something like that, right? The next month, because I bought a partial share. Well, as the years have gone by, Schwab, which is the broker that I use, they no longer have a trading fee when you purchase stocks. So every so often I'll buy a partial share. And so that'll be like anywhere from 15 to 35, 40 bucks. The stock generally trades around $55 to $70. I think right now it's around 61 or 62. So as it stands now, at just over 8 years of being invested in that stock and reinvesting every dividend period, I now have 111 shares and change, like 111.2 something or something like that. And it generates just under $30 a month. It was $29.70 last month. So the increase from the beginning is about 221% from the $13. And so I did a projection on that. And if I just left it alone at the current rate of what it's doing, just reinvesting, the stock would be worth about $19,800, just under 20 grand in 20 years if I don't do anything. But what I plan on doing is buying a little bit when it goes down. So there's been times where I've sold a few shares and there's times where I purchased shares. But for the most part, I've just been accumulating shares. And so the stock's down just a little bit, so I got it on my radar to see if it's something I want to invest in. I've been doing more of these covered call funds lately, and that's been taking most of my time with researching those stocks and seeing which ones pay because the dividend's so much higher, but the price is very volatile in those stocks. So coming back to these REITs, they're a little bit more stable. They are sensitive to interest rates, and with what's happening with the Fed, we got a new person coming in. They haven't really priced in rate cuts because the latest talk in the last week or two is about increasing rates due to the inflation with the situation in Iran and the oil prices. There's just no hope for, interest rate cuts of like a full percent or so. Generally, we get 0.25% cuts, and it's just the information is just not there to justify it at the moment. And so the fact that we got a new guy, the fact that the inflation numbers came out in the last week, that didn't look great. The markets reacted really poorly in the last couple days, just in general. So some of these REITs are back under pressure again. And, I kind of like that. I like the fact that the price moves around because it gives me a chance to buy them when they're low and then trim them back and sell a little bit when they go high. So with all that in mind, it's pretty amazing. I now have, 110 shares from the 50 some that I started with. So nearly double in the position. My original investment is only up a small amount, like $400 or $500 on the $3,000 that I invested, but that's fine. I want this as like a stable portion of my retirement account that is an anchor. And so I have a few stocks like this where I don't really expect a lot out of them, but when the market goes crazy, they just kind of do their thing, and they're kind of independent from the rest of the market's craziness. So, you know, it's a double-edged sword. You don't get the huge growth, you don't get the huge profits, but occasionally when the stock is under pressure, you can take advantage and buy shares when they're low and just accumulate them. Because my purchase dividend rate is about 5.9%. And any new shares that I bought right now, the interest rate's like 5.05. So it's pretty interesting to compare that if you buy it when it's low and you just hold on to it, you can actually get a little bit more. But it just depends on how the market is at that time, and if you do like a lump sum like the way I did at that time. And so I also, because I'm figuring I want to add to this position, I did a comparison and I ran it through a dividend calculator, and it said that if I just invested $30 a month starting from today, that instead of it being worth $19,000, $800, it would be worth $30,000 and change. So that's a pretty big eye-opener that just small amounts on a consistent basis, done over 20 years, $30 a month, it's really not that much, really could be a game changer with getting some of these holdings to really significantly improve. So in doing research for this video and just looking at my own holdings, I ran it through ChatGPT to ask some questions to see, does it make a difference if you reinvest the dividends or you do purchases every so often? And the takeaway I got was, if you set it to reinvest, the holding will do a lot better because it's taking away the human element. And really what it is the friction. And what I mean by that is you have to decide to make that purchase. And what if you look at it and it's up 4% that day? You might make the decision that, it's not a good value, I'm not going to buy today. Well, then it goes up another 2%, another 3%. And the next week it goes up another 3%. And now you just kind of write it off because you figure it's not worth investing in because the price isn't low anymore. Might take a year or two, might never come back down, who knows? But you stopped investing at that point and you move on to other things. And so that's why, for the most part, I do set my dividends to reinvest, because I call that getting out of my own way, where I don't worry too much about it and I just let it do its thing. So what you can do though is let it reinvest. And the strategy that I use is when it does get to a 52-week high and it's really going crazy, I still let it reinvest, but every so often I'll sell a few shares out of it and I'll put it in something else. And so that means the compounding will slow down just a little bit, because now I've removed whole shares from that position. So I might lose, 50 cents, $1, $2, depending on how many shares I sell, but it frees up cash. And the next time it comes back down, I'll buy whole shares again. And then, the other holding that I'm buying, I'm getting a better value. That's the way I look at it. But really, that's kind of like a hybrid approach. And some people might consider that just too much work. They don't want to hassle with tracking it, figuring out what to do. So that's why all these approaches are really just up to you, how you want to do it. But if you just let the cash sit there, you have to make another decision on what to do with it. And so it's kind of a tough call. I've been through a few market cycles now where I've seen some of these different stocks have their heyday and the days where they're just hated. So it's very interesting. And I have to just consider what has happened in the last few months, what's happened in the last year, what's happened in the last couple years, what's the all-time. That's kind of how I look at it for some of these things when I'm deciding to do these trades. But for the most part, on these REITs, preferred stock, closed-end funds, anything that pays a dividend on a monthly basis, BDCs, I generally let the dividends reinvest. And then when they really have a nice comeback, I'll start trimming from the highest cost basis to get them out of the holding. And then from that point, I can buy something else very low. And so currently I have another REIT that I've been selling, and I had just crossed over 100 shares. So it's kind of a cool milestone to hit on that. But, the dividend's rather low compared to the other ones, but the price is more stable. And now I'm sitting at a 15% profit on everything that I bought, including the reinvested dividends. So in reality, that holding is probably up like 28% because the dividend is around 8.5% based off when I bought it. And I've been in that stock about going on 2 years now, just under that. So really, it's just a matter of being patient. Some of these things don't really seem like they move until they do. And then by that time, it's kind of too late. So I really just let them run. And then when they have like a 52-week high or they're getting close to that, I'll really monitor what I want to do and if I want to trim it or not. So in doing all that, that's one time that I did it as a lump sum where I put in almost $3,000 at one time. So I have a different fund that's more of a dividend investment fund that one of these high yield funds that promises like between 9 and 12%. Well, the performance on it has been very poor and the actual share price has just continued to go down over the years. But I've reinvested the dividends since 2020. So it's now going on the 6th year and the dividends are really cranking out. So there hasn't really been an issue with them paying. It's just the underlying holdings that they have inside that fund have not been doing well. And again, it comes back to the interest rates. So it's kind of like you have to pick different risk levels of what you want to do and what's worth it to you. So with this fund, it's more volatile, it's more risky. But because I've reinvested the dividend and the rate is higher, it's probably like 11% right now. The fund is negative, probably about 7 or 8% based on when I last looked at it. And I continue to buy shares, 2 to 3 shares a month, just to keep adding to it while it's low. A little bit of that mentality is a sunk cost fallacy where you've already invested in it and you just want to, try to build up the shares while they're cheap. But the general outlook right now, because of the Fed, is that they're not going to lower the interest rates. So you can look at it 2 ways. You can get frustrated and sell it and just be done with it. Or you can ride it out, get paid while you wait, and just let it do its thing. And so that's what I'm doing there. And so on that fund, I want to say I bought something like 10 or 12 shares in March and April of 2020. And I was only getting $1 or $2 of dividends every month. And I was out of cash at that point. It was just a very difficult time. You're really under pressure to make decisions. The market seemed like it was just really going down day after day. And it was just a difficult time to trade. So since it was a retirement account, I just figured, you know what, I'm going to build this position. And so on that one, I said I was down about 8%. It's down about maybe $600 on a $400 to $800 investment of cost basis, which includes the dividends. But if I elected to have the dividends just deposited as cash, I would get somewhere between $48 and $50 a month. So I'm at a point now where I think I might just let it finish out maybe through June or July on reinvesting the dividend. And then at that point, actively sell shares. So I'll let it reinvest, but I'll sell between 2 and 3 shares every month to try to get the share.
Lot 1, 2234.
I can use that money for other stuff. And if the Fed does cut rates within the next year, I still have shares, but I'm really not chasing a sinking ship, if that makes sense with what's happening here, a falling knife. It's kind of a tough decision to make because I could make more on the dividend, but I don't know when it's going to recover. I have faith it will come back, but it's just going to take time. And so that's what a lot of this comes down to is, the best use at the time for the money. And, with the retirement account, you really should be long-term minded. And sometimes it's hard because you want to see instant results. So I'm constantly having to remind myself, okay, this one, give myself an allowance to sell 2 shares of this one per month, 1 share of that one. It might not seem like a lot, but when you run out of new funds to deposit, because I'm getting pretty close to the max for the year, you can only deposit so much per year. And then at that point, you have to trade in that account or rely on dividends within the Roth IRA to, buy new things. So it's kind of just like a mental juggling act to try to figure out which is the best use of funds at the time. So as I mentioned on some of my other videos, you can check them out on my channel here. I've done really well in oil and gas stocks in the last 2 years. And I probably was really actively purchasing these about 3.5 to 4 years ago. And then still occasionally buying on dips. But, I'm getting returns of between like 75 and 150% plus dividends. So those are like home runs in my opinion of like how they went. It's a best case scenario. And in some cases I had previously bought and sold the same stocks and made similar gains. So that's kind of like a reliable channel that I can come back to. You just have to wait those out too. So it's interesting to have different stocks and see them move in different relationships to the economy. Right now all the narrative is about the interest rates and the oil price. And so it's going to take some time to get through all this. But once we do, stuff will start to kind of feel somewhat normal. But, the difficult part, just as an investor, is there's always something around the corner. So, we had COVID in 2020. Then it was supply chain issues. And then you even had some companies cutting or eliminating dividends for a period of time. You had layoffs, you had remote work. The oil prices were really low at that time. And then little by little, things started to come back. And we finished the year up a little bit in 2020. And then in the subsequent years, you got the Ukraine war. You got that situation with the supply shortages again. Issues with food supplies. And now with this Iran situation with the Strait and the oil, it's just really, right when it seems like things are going to get back on track, there's a wrench in the system to cause a problem. So just as an investor, you have to be nimble and you have to be willing to just roll with it. You can't, you're playing the game. You're getting rewarded with these great returns, right? Like these 50, 75%, 150%, 200% returns. You can get that. It's just you have to be patient and you have to wait out these cycles. And you can get lucky and get in at the end of a cycle, or you can be, frustrated and sell at a loss. So it's really just the mentality of I'm buying something and I'm putting it away and I'm going to let it do its thing. And that's the biggest improvement that I've seen in the last couple of years on my trading and my investing in general, has just been able to detach and allow the process to play out. And if you put too much money in at once, it could cause a problem, because then you'll have buyer's remorse when the stock goes down. And so that's the thing with the dividend investing. It'll help smooth out the return. It'll be something where you can rely on that dividend income to just build up your position over time. And you'll just have more shares month after month. And, it's really just a long-term game. And to see my holding in that REIT go from $13 to $30, it's pretty cool. It's a real slow burn. But, by that time, if I do the 20-year extrapolation like I did on that calculation there, it might have a dividend at that point of around $65 to $70 a month, because this particular one does increase the dividend every so often. So it's really just about keeping myself motivated and just keep it on its own. Don't let it distract me from everything else. And that serves a purpose within the portfolio. That particular REIT, I think it only makes up about 4% of what I own. Some people may think that's too high, but in general with the REITs, I'm about 20 to 22%. I think at last check of my holdings are related to real estate investment trusts. And so I just use them for what they're good for. They're reliable on the income. They can compound month after month. And then when they have a 52-week high, I'll trim some of them back. And, in this other high yield dividend fund, it's not really performing well. But the dividends on it is cranking out, close to $500 a year. Or actually more than that, almost $600. So, it's all in the way that you look at it. If you get obsessed with the price and you see it's not really performing, some people might just want to cut it immediately. I'm going to stay with it through the summer, like I'm saying. And, we'll see how it plays out. I'll give you guys an update on how it does. But, just in general, it's been a portion of that portfolio. And even if I take out the loss, if I'm getting $600 a year on the dividend, keep in mind it'd be a little bit less on prior years, right? Because it's still compounding. But let's say it was $500 last year, $450 the year before, and etc. I probably got probably close to $2,000 in dividends on that stock just by holding it all that time. But it's just been slow. It's been 6 years times 12 months, 72 months worth of payments to get $2,000. Some people might think that's not even worth it. But when you figure I only invested on share prices, I probably only invested about $1,800 or so. At this point, more than half of the holding is from the dividend. And so that dividend just keeps compounding month after month. So these are just the way I look at it. You know, at a certain point with some of these though, when they hit 52-week highs or they start coming back and you want to cut them loose, even if they're just kind of mid performers like this, there's other opportunities. And I don't let any of this stuff get to me anymore. I used to really be anxious about it and trying to like, did I make the right decision? Did I do this or that? So I just kind of stick to a plan of this is what I want to do per month with this stock. And that's kind of my limit of where I want to do what I want to do. And then when the opportunity arises to sell, I can do that. So that's my take on dividend compounding. That one figure though, from the realty income, if I just invest $30, I can get an extra $10,000 on the value of that in the next 20 to 30 years. It's pretty amazing. So, you know, I'll put a link in the description here for the dividend calculator, and you can run your own simulation. You'll have to like use your own cost basis to determine it. It's not going to be a perfect estimate, but at least gives you a range of what you can expect. And so keep in mind, with the way I'm doing my Roth, I think I have about 12 positions that are monthly dividend payers that reinvest every month. So that money is just growing month after month. And, you know, like it started with realty income, $13, you know, and it was like a 10-cent increase the next month. You have to be active with these. You know, you can't just you can set them and forget them, but at the same time, you want to use new money to your advantage. So, you know, it's really a lot of juggling mentally with how I look at it. It's not just like I'm buying these 100 shares and I'm done with it. I need to evaluate it on a, you know, maybe a 3 to 6 month basis to see how it's doing in the beginning. And then from there, as I've learned about the economy and how everything works with interest rates, get a little bit more into it in terms of like having a goal and like setting aside a certain amount of money to go into that particular stock or ETF. And so, as I mentioned, I've been really into these covered call ETFs, and they've really pulled back in the last couple days. But for the most part, I'm doing pretty well with them. Schwab updates your past year and your current year with your dividends. And so what's pretty insane is you go from, you know, $4,000 in dividends from last year to over $9,000 in dividends in this next year. But that's mainly due to these covered call funds and how much I have in them. So anyway, I'll do another breakdown on that. But thanks for watching, and we'll see you in the next video.